The trend trading strategy is one of the oldest, most popular, and potentially the most lucrative longer-term trading strategy. Similar to swing trading, the trend trader usually uses technical analysis to determine the overall direction in a currency pair. However, trend traders generally have longer time periods for exiting trades. Trend traders usually look further into the future, who may also take various forms of fundamental analysis into their purview. Usually, trend traders will first determine the current trend for a market by analyzing the charts and placing trend lines between higher highs and higher lows during an uptrend, whilst the downtrend is identified by a series of lower highs and lower lows. Breakout points are determined when the pair breaks above major resistance levels or trend lines, or breaks down below major support points or trend lines. Major support and resistance lines could be determined by prior points that have not been reached in a substantial time period. For example, a previous higher high from a month ago or 6 months ago. Hence, sometimes the phrase that may be heard, 6-month lows or year-to-date highs. Trend traders can also use moving averages to find crossovers, such as when the 50 moving average crosses over the 100 moving average, indicating when the short-term trend is changing in relation to a long-term trend. In general terms, when the moving average of a shorter duration or the price crosses over a longer-term moving average, such as the example mentioned above, it may generate a buy signal in a pair. On the other hand, if the short-term moving average falls below the longer-term moving average, such as the 50 moving average crossing under the 100 moving average, this usually generates a sell signal. Trends in currency pairs that are traded in the Forex market are often detected when changes in the underlying economic cycle become evident in one economy relative to another. When the economic cycle starts to shift, the central bank's monetary policy direction and interest rates tend to be affected, as the central banks move in to correct the divergence. Once a trend is identified by a trader, they can then formulate an entry and exit strategy. For example, this might involve going long on a market correction in the event of an upward trend, or waiting for a rally to short the market in a downward trend. After the trader's position is established, the trader, due to his longer-term outlook, rides the position for as long as the trend runs its course. An effective money management tool is usually adopted by traders by maintaining a trailing stop loss on their positions in order to protect their profits that have already been gained, by minimizing the potential drawdown from sudden corrections or market moves, where exchange rates move in the opposite direction of the prevailing trend that was previously identified.